Hello and welcome to Your Money, Your Call. I'm Kim Slater, filling in for Chris Kimber, who's unfortunately sick tonight. If you have a question about shares, our phone lines are open on 1300 30 34 35, or if you prefer, you can email us at yourmoney@skynews.com.au. Great to have you with us tonight. Tonight I'm joined by Simon Gazowski from Beresford Financial Planning and Russell Muldoon from Montgomery Investment Management. Gentlemen, welcome to the program.
Thanks, Chris.
Chris. Russell,
Sorry,
you're falling into that old trap. Today, the lightning rod for the market was obviously the CPI figure. So good news if you'd bought a TV, travelled, drank soft drinks, didn't eat veggies or go to the doctor or rented and didn't spend on education, then you obviously got the benefit of the lower CPI. We've got an annualised figure of 1.2%. 37 of the 87 baskets recorded annualised increases of 2.5% more. So a bit of a mixed picture coming through, but overall the headline figure is what the lowest we've seen in 13 years. Market liked the look of it. Simon, what's your take on that CPI and how that's going to flow through into interest rates?
Well, I think exactly right. The key thing with the CPI here is there's nothing really holding back the RBA from cutting rates further. Even though we are apparently in a bit of a commodities boom, a lot of the countries is not benefiting from it. And I think with Europe deteriorating and a really low CPI number, I think there is now quite clearly some room for more rate cuts.
And Russell, your thoughts on rates?
Yeah, look, I think I have a view that an easy way to sort of work out where interest rates are going to go over time is add together GDP and inflation. So if inflation rate, as we just heard, was 1.2%, now GDP is running at 2.5%. That means our interest rate should be tracking between 3 and 3.5%. Now, the cash rate at the moment is around the 3.5% mark. So look, the IMF said we're downgrading forecasts for Australia down to around 2%, inflation at 1.2. So look, there could potentially in the pipeline be another 0.25% cut coming from the RBA very, very soon. So I think it's a very good benchmark to watch if you're trying to look at interest rates. You're trying to watch where they're trying to go. Simple formula: GDP plus inflation. So obviously, when the cycle does turn and GDP starts to improve and inflation starts to rise again, we'll see interest rates.
So is your thought the RBA is going to move in one cut, or is it going to be a series of orchestrated cuts, say between now and Christmas? So Russell, look,
I think we're probably due for a 0.25% cut, more so than a 50 basis point cut. And the reason for that is basically because of my formula: 1.2 plus 2.5 gives 3.5. So look, I'll go in between that and say 0.25%.